The importance of long-term investing. It's important to consider the market you're entering when selecting assets to invest in long-term. The current volatility of the market is a good example of how things can unexpectedly change and how you need to be prepared. In the current economic climate, long-term investing may be viewed as a safer route to take for your financial future. In the past, when we have experienced a less turbulent market, it may have been more appealing to avoid long-term investments and chase short-term investments that provide quick returns. But with current market volatility and high valuations, it's worth investing your assets for the long term. However, this can be a bit of a double-edged sword with the current volatility of the market. Whilst any short-term investments won't boast as good returns as they would in a stronger market, it is also nerve-wracking to be a long-term investor seeing the stock market suffer when you want your assets to grow. But it's important to remember, as history shows, the markets tend to recover. How to invest money long-term. As we mentioned above, building a diverse investment portfolio is important because it allows for balance within your investment so that you don't have all your assets too heavily invested in one sector. We want to help you find the best long-term investment options for your financial needs, and we've put together some top tips for successful long-term investing. Know how much money you have available to invest and how much you could potentially afford to lose without impacting your standard of living, both current and future. Have a financial goal in mind. Do you want the funds to be put into an account for your children? Is there a sum in mind you have for retirement? Select the best strategy for you and your financial wants. Keep calm. In the face of market volatility, it's key to hold your nerve. Understand the risks of your investments and the risks you are prepared to take. Start building a diversified portfolio. Manage the costs of investing. Make sure you're aware of the costs you need to pay, such as management and advisor fees. Review your strategy regularly and seek investment where appropriate. Warren Buffett is reported to have once said, "You don't need to have extraordinary effort to achieve extraordinary results. You just need to do the ordinary, everyday things exceptionally well." Here is an inspiring true story in this regard. It might sound too simplistic to be true, but if you doubt the Oracle of Omaha's wisdom, you should hear the story of Ronald Read. Ronald Read, a retired gas station attendant and janitor in Vermont, passed away in 2015. Nothing about his life or death was extraordinary, except for the fact that after he died, his estate was revealed to be worth $8 million. This was a surprise to much of Ronald Read local community. He was a hard worker, but I don't think anybody had an idea that he was a multimillionaire. His stepson told the local press after his death. Ronald Read didn't have the type of career path you'd typically associate with a multimillionaire. So how did he pull it off? Here's a closer look at the 3 simple techniques that made him so wealthy. Frugality. Ronald Read seems to have had a reputation for being extremely frugal. In fact, he likely could have given Buffett, who is famously frugal, a run for his money. Read's friends remember him driving a second-hand car and using safety pins to hold his worn-out coat together. He even continued to cut his own firewood well after his 90th birthday. It's a painfully straightforward approach. Spending less than you earn leaves you more to invest and generate wealth over time through investments. "I'm sure if he earned $50 in a week, he probably invested $40 of it," said Read's friend and neighbor, Mark Richard, according to CNBC.